Hello everyone and welcome back to Am I Too Late? I am Naho, a late starter helping other late starters build financial and digital confidence. This episode is the third part of my mini pension series. So if you've been following along, last time we looked at how tax relief boosts your pension. That automatic 20% top-up from the government. Well, technically it's more of a refund than a top-up, but either way, it's one of the easiest wins you can get. Today, we're moving on to how much you can put in, how to catch up if you've fallen behind, and how to tidy up those old pension pots you might still have floating around from past jobs. For me, this one's a bit personal. After talking about pensions for weeks, I finally opened my own SIP. That's a self-invested personal pension. I've chosen Investor Engine mainly because their fees are low and it felt right for me. But other SIP providers are available, and I'll share a comparison soon on Instagram if you are comparing options. So if you're not already following, find me on Instagram at Am I Too Late Podcast. Okay, let's start with what you can put into your pension each year, because this is where a lot of people either underestimate or get stuck. The current limit, known as the annual allowance, is 100% of your earnings or £60,000, whichever is lower. That includes everything paid in, so your own contribution, plus anything your employer adds. And here's where late starters get a bit of an advantage. So you can carry forward any unused allowance from the past 3 tax years. It's genuinely one of the best catch-up tools available. So if you've only been adding small amounts before, but now have room to do more, maybe you've had a pay rise, changed jobs, or built up some savings, you can use that leftover allowance to top up. You'll just need to have enough earnings this year to match what you're adding. One thing to keep in mind though, your allowance is based on your total earnings for the current tax year, which runs from April to April. So you won't actually know your exact limit until the year ends. That's why a lot of people wait until later in the year to make any big top-ups, once they've got a clearer picture of their income. Remember that the maximum limit applies across all your pension combined, workplace and personal, not each one separately. And those top-ups don't always have to come straight from your monthly income. If you've got cash sitting in your current account or a lower interest savings account, consider whether some of it could work harder inside your pension instead. If you don't have any earned income right now, say you're between jobs or taking a career break, you can still pay in up to £2,880 a year. And the government automatically adds 20% tax relief to make it £3,600 gross. Just make sure you keep enough aside, ideally 3 to 6 months of living cost, so you are covered for emergencies before locking the rest away for the long term. Because remember, once it's in your pension, you can't access it until a certain age. Now, before we go any further, it's worth knowing what counts as earnings for pension purposes, because not everything that's taxable qualifies. So, relevant earnings include things like your salary, wages, bonuses, overtime, or income from self-employment, basically the money you earn through work. But here's the confusing part. Some types of income, like rental income, dividends, or interest on savings, are subject to income tax, but HMRC doesn't count them as relevant earnings for pension purposes. That means you can't use those to justify extra pension contributions or claim tax relief on top of them. So if most of your income comes from property or investments, it's something to plan around. You can still contribute the flat £2,880 a year, which becomes £3,600 with the government top-up, but you can't stretch your pension limit any further with those other types of income. And if you're self-employed or juggling part-time and freelance work, it's your total earned income from work that matters, the taxable income linked directly to the work you do. Once you know what counts as relevant, it's much easier to plan your top-ups confidently. and avoids any surprises later. Now let's talk about something many of us quietly avoid: old pensions from past jobs. If you've changed employers a few times, there's a fair chance you've got a few small pension pots scattered around. Maybe one from a job in your 20s, another from a workplace you left ages ago, and perhaps one you vaguely remember signing up for but never looked into again. The first step is simply finding them. You can use the free pension tracking service on gov.uk. It helps you locate old workplace or personal pensions even if you've forgotten who managed them. Just a few minutes, and you only need the name of your old employer. But here's something extra to check. If you can't find your employer's scheme name in the database, it might be that the employer never actually set up a pension scheme, especially if it was a small company many years ago, or the job was before automatic enrollment rule came in, which was around 2008 to 2012. In those cases, reaching out to the business owner or an old colleague might help you check whether there was a scheme and if you are enrolled. Once you've found your pots, dig a bit deeper. Check what funds they're invested in, what fees you're paying, and whether those funds still suit your goals or risk level. Then consider whether it makes sense to consolidate them by moving old pensions into one place so they are easier to manage. Platforms like PensionBee, AgeBell, or InvestEngine often makes this very straightforward. Just check for any exit fees or special guarantees before you move anything. Things like protected tax-free cash or guaranteed annuity rates can be surprisingly valuable and are usually lost if you transfer. Here's the scale. According to the Pension Policy Institute, there are around 3.3 million lost pension pots in the UK, worth a combined £31 billion, an average of about £9,500 per pot. And the government's working on new rules to make this easier in the next few years. Small or inactive pots could be automatically merged into better value schemes, and it should become clearer how your pension's performing and what you're paying in fees. I'm recording this in late 2025, while the pension schemes bill is still making its way through Parliament. But the direction is clear: simpler pensions, more transparency, and hopefully fewer of those forgotten pots in future. I'm in the process of bringing mine together now, partly to cut down the admin, but mostly so I can see the bigger picture. Once it's done, I'll share what I learned, just in case it helps you do the same. The main takeaway here is this: don't leave old pots untouched just because they're small. Once you know where they are and what they're doing, you can decide whether to keep them, move them, or start contributing again. A bit of spring cleaning now can make a big difference later. So what happens when you finally start taking money out of your pension? In most cases, you can access it from age 55, rising to 57 in 2028. When that time comes, the first 25% of your pot is usually tax-free, and the rest is taxed as income. And honestly, I found that part really confusing at first. I remember thinking, wait, I thought pensions were meant to be tax-free. If I'm going to be taxed when I take the money out anyway, what is the point? It just didn't make sense to me. Why give tax relief up front, only to tax it again later? And to be honest, I didn't really get what that 25% tax-free actually meant at first either. But here's what I've learned since: that tax relief gives you a bigger pot to begin with. And because that extra money is invested and growing too, your returns are compounding on a higher base. So over the long term, the growth often outweighs the tax you'll eventually pay when you start taking money out. Plus, many employers add their own contributions on top of yours, so that's essentially free money. And it counts towards your retirement pot from day one. When you think about it, between the government top-up and your employer match, you're already starting far ahead of what you could build on your own. Still, it's one of those things that makes you realize pensions aren't the only answer. They are powerful, but they work best alongside something more flexible, like a stocks and shares ISA. And that's exactly what we'll explore next time. The balance between pensions and ISAs, and how to make your savings as tax efficient and accessible as possible. Okay, let's wrap this one up. If there's one thing to take from today, it's this. Your pension isn't just a box you tick once a year. It's something you can shape. Whether that means topping up a little more using your carry forward allowance or finally tracking down those old pots, every step gives you a clear picture of where you stand. So here's your homework. Check your total contributions for this tax year and see if you've got any unused allowance from the past 3 years. Trace any old workplace pensions using the free pension tracking service on gov.uk. Review what you've already got, fees, fund types, and whether they still fit your goals. And if you've got cash sitting around earning next to nothing, think about how much you could move into something longer term once your emergency fund's covered. If you try any of these, or there's something I didn't cover that you are wondering about, let me know on Instagram at Am I Too Late Podcast. And if the bit about balancing pensions and ISAs got you thinking, make sure you follow or subscribe to the show, because that's exactly where we are heading next. That's it for today. Thanks for listening. And remember, you are not too late. You're here now. That's what matters. Let's start today. See you next time. Here's the disclaimer. Everything I share here comes from personal experience and learning. This podcast is for information only and isn't financial advice. Please do your own research and talk to a professional financial advisor to find what's right for you.